All right, well, greetings everybody, and welcome back to the April session of the Roundtable, especially if you're returning. And again, an extra warm welcome, as Ken just said, to anybody who might be joining us for the first time. I'm joined here by Ken Kavula. Ken is a nationally known volunteer and educator for the Investment Club Association, and we're joined also by Hugh McManus from Pasadena, California. He has also been very active as an educator and an individual investor going back now over a couple of decades. I am managing partner of Manifest Investing, and we're also joined tonight by one of our guest knights, Matt Spielman, who's in tonight for Silence, who's unable to join us. If that name is familiar to some of the regulars here, Matt was among the guest knights who took away the most award statues during our February session just a couple of months ago. So it was Matt and Herb Lemkool and Nick Strategos that took away quite a few statues. So Nick and Herb will be cheering Matt on tonight as he adds another selection to their process. We're going to be doing a couple of stock presentations tonight on Universal Display Corporation and Air Lease. We'll get to those here in a minute. If you have any questions about this session at any time, you can, or if you want to be added to a reminder mailing list, you can write to Ken's wife, Natalie, at nkavula1@comcast.net. And also you can write to me at markr@manifestinvesting.com if you'd like to do any follow-up, if you'd like copies of slides, or if you have any questions following the presentation. Here's our quick housekeeping about the rules of engagement. No investment recommendation whatsoever is intended. This is all about education. We're basically demonstrating a philosophy and a process that has served so many of us well in the modern investment club movement. The process of analyzing companies, coming to understand companies and truly own them as an effective steward. That's what we do, and this is entirely about demonstrating that and helping people understand that process better. So that's what it's about. Again, do your own homework, make your decisions. We're not issuing buy recommendations. We're issuing study recommendations and techniques here. Here's our quick standing agenda. Do pretty much the same thing every month. We'll take a look at our results to date, and then we'll launch into the presentations. Matt Spielman will be talking about Air Leasing Corp., ticker symbol AL. And then again, for the second time in the nearly 4 or 5 years we've been doing this, Ken and I have agreed on a selection. That's Universal Display, ticker symbol OLED. And I'm going to kick it off. And I think we came at it, and this is unrehearsed, I think we came at this in from two separate directions. Didn't collaborate on that at all, but we are going to collaborate on showing you the discovery of it and then some of the details about what they do in the two combination presentations. Hugh McManus again tonight. Can't find anything to get excited about on his basically his pounce pile of companies that he keeps track of. So he's going to pass again this month, but Hugh, you're invited to chime in. I know you do a lot of stuff with the airline thing, so as Matt goes through his thing, if you've got anything to add to that, please feel free. And then, of course, towards the end, if anything that you want to share with the audience, please go ahead. Here's the introduction to what we do. Again, this demonstration, we come together, we try to bring what we think to be single best ideas. We do keep track of the portfolio with a tracking portfolio. We do want to try to beat the Wilshire 5000, the general stock market, by 5 percentage points. And we really would like to see 3 out of every 5 selections that we make actually outperform a mirroring or matching investment in that Wilshire 5000 benchmark. So how are we doing? Again, the long-term trend is quite good. We are in that 1 to 2% range, but that's a whole lot better than the -4 on the left side of that chart. We do want to get up to that red line and hopefully keep it there. That dotted red line across here is what the typical investment club uses as an objective, trying to outperform the general stock market by 5 percentage points. And again, we would like to see this number down here at 60%. We have been up pretty close to 60. We've kind of come back a little bit. The market has been a little bit choppy. We have a number of stocks that have hit speed bumps like Coach and they're balanced by other companies like Apple that seems to be doing pretty well here the last several days, and that's actually boosted our results pretty well. But again, we kind of have trailed off here the last few months, but again, we don't get too heebie-jeebie over that. Okay, just kind of ramming through. Here's a look at the portfolio from the largest holding. This actually is the listing of the top 20 largest holdings by percent of assets. And basically the way you break this down and understand this chart is anytime any one of us, any one of the knights or guests that are here selecting a stock, or the audience vote selects a stock, we basically take and invest $1,000 into that stock. So in the case of Cognizant Technology that you see here at the top of the chart, that's actually been featured by 9 different selections over the last 3.5 years. So $9,000 invested is now worth $12,219. So you can kind of break down the entire chart in that manner, looking at, as we mentioned just a few minutes ago, the one night that Ken and I both agreed on, Fossil. And it's actually been now a 5-time selection, as you can see right here. So $5,000 invested into Fossil is now worth $6,264. So any comments on any of those guys? Matt was saying Caterpillar. There's Caterpillar bubbling up onto the chart. That's one of the reasons Hughes stuff has been doing pretty well here lately. Again, any concerns about Bank of America?
No, it's long term.
Long term.
Yeah, apparently they're not good at doing numbers, but that's fine.
They're only a bank, man.
Yeah. Actually, how many times has Caterpillar been bought? Was it 3 times or twice?
It says 3 times on here.
Oh, it's 3 times. Yeah, okay.
But it's been doing pretty well lately.
Mm-hmm. And Staples has been misbehaving, but these things happen.
It's also long term.
Yeah.
Any comments on any of these from you, Ken? I noticed that Vera Bradley is kind of recovering. And what's Vera been featured? A couple of times.
3 times for Vera Bradley, I think. Yeah, I'm still feeling really good about that particular company. I'm also feeling really good about portfolio recovery. It's only been featured twice, and if you'll notice, it's worth $5,000 now. So that's been a great stock to take a look at. And this evening at our Wolves Investment Club meeting, we noted that for our SSG, at least, it was in the buy zone again. So it might be another stock to really do a study on and do a little bit of work on. Priceline also has been treating us really well. We've only picked it 4 times, and it's worth $6,200. The Wolves this evening showed Priceline as a very strong hold, almost a buy, but not quite. So I think there's still some great stocks on this list. To get the entire list, if you go to the Manifest Investing site, and over on the right-hand side, you'll see that we have a list of some different dashboards, and that you can pull up the whole dashboard. Here's Mark showing you right on home, and right there, the second one on the list is the roundtable dashboard. You can see the entire dashboard listing every single stock we've picked, along with that legend up at the top telling you when we've done it a couple of times or more.
Yeah, and this is a public link up at the top. You just have to remember public roundtable for the suffix. And again, if we were shopping inside the portfolio tonight, might be interesting to see what's been going wrong at Newstar. That's one that's been hit. Some of these have actually been hit. I know a few of the people in the community have been seeking answers to what's going on at IPC, the hospitalist, because that's also taken a hit. And sometimes those can represent buying opportunities.
Mark, we're getting some questions right here. One of them is of a real general nature. Dolores would like to know, where can she find past recordings of the roundtable on the Manifest site?
Oh, it's a great question. If you just click into events, if you click on events, you can see the promotion for tonight's event on the left-hand side there. But if you go over onto the right-hand side, you can find past events, and even more importantly, recorded events. Clicking on that takes you to a pretty hefty listing of things. Here's the March session for the roundtable. Here's this was actually the February session where we did hand out some trophies. Some sessions on using the dashboard, and then just go down the list. Some that people have really liked over time. This Motley Fool session was actually pretty good. And then there's also one down here on screening, searching for stocks. And again, you can find all kinds of different webcasts saved under events. Again, I'll click through it again. Under events, and on the right-hand side, recorded events. Okay? How are we doing on questions, Ken?
We have another one here. Nancy would like to know if anybody has any thoughts on the Apple split. Is that going to really make any difference?
Well, I mean, it will in terms of, well, no, I mean, it doesn't do anything fundamentally to the stock. I believe they're talking about a 7-for-1 split, and which is strange, which is unique, and leave it to Apple to do something unique. But what it does do is it enables it to be included in a number of things like the Dow Jones Industrial Average, and many people think that's what they're gearing up for. And they pretty much have to do that 7-for-1 split in order to do that. So it'll be interesting to see if that actually happens. But yeah, it's kind of a non-event, but it makes it cheaper to own 100 shares.
Yeah, I thought the inclusion in a number of different indexes, not just the Dow, but there are other indexes that have kind of excluded Apple when probably it should have been included, but the price kind of kept it out of the index to start with. So I think that's a real interesting twist on the whole thing. Mark, Don mentions that our portfolio, and maybe if you went to the home page and clicked on the portfolio, you could show the graphs at the bottom of the dashboard. Don says that it seems to be kind of tech heavy, and are we worried if there's a correction in the market in tech stocks?
No, we never worry. Let's go ahead and take a look. We are tech heavy. I mean, that's one of our favorite 5 or 6 sectors.
Out of 10, right?
Out of 10, yeah. I don't know what's taking so long. I guess got too many dashboards. Hold on. Might have to come back.
While you're bringing that up, Jane Johnson from Western Michigan says that she's read that a recent study shows that stocks that split their shares tend to perform better for the next 3 years or so than comparable stocks that don't split. That's research from Bottom Line Personal. But it's an interesting take on the whole idea of a split. Jane, do you have a month or a citation where people that want to read that study could come up with it? If you do, put it into the chat box and I'll send it along to our audience.
Yeah, and we could post it in the forum too. It would be interesting to see. I do know that there's a bump and a turbulence around every stock split from a trading perspective, but I haven't seen too much longer-term research. It'd be interesting to take a look at that. Here's a look at the sector diversification for the roundtable.
And then, of course, splits haven't been as common recently.
No, the last couple of years I've been in heaven.
Yeah, in the 90s it was just amazing.
I'll say, Mark, that I didn't think that I would have guessed that we had more than 45% in tech. So seeing only 35% makes me feel kind of good about that. I guess that shows you how much I really watch this particular sector diversification chart when we're putting together a portfolio.
Yeah, we don't. Our part of our mantra, I guess it is to not really focus on sector diversification, but simply go where the opportunities are. And if you do that by investing regularly, this should actually even out. It's actually, there's 5 sectors here represented pretty well. I'm a little surprised that Staples is a little bit lean, but that'll fix itself too. So the sector diversification is pretty good. The size diversification based on growth is also quite good. It's pretty evenly distributed, and the overall growth rate is, let's go up to the report card. The overall growth rate, and we'll be going over this in a minute, is 10.1. We'd like to see it a little bit higher, but again, nothing catastrophic about that either. So pretty good stuff all around. All right, let's go ahead and dive back into the portfolio itself. Here are the stocks which would be candidates for challenges, but again, the mere fact that we don't have a real need to challenge anything, and unless anybody knows of anything catastrophic going, boy, look at Caterpillar is just running. That's actually driven the return forecast down to 3.9%, but the overall par is in pretty good shape at 11.5. Quality's fine. And again, this should be, we'd like to see this a little higher, but the growth is actually pretty good too.
I do have a question for Hugh, Mark. Hugh, how long will you allow Staples' growth rate to be flat before you decide that the thesis that you originally purchased it under is not working?
So I wouldn't really pay too much attention to the growth rate. I'm just looking at Staples and the environment in which it's competing. The concern I would have is if companies like Amazon and other online retailers would start to eat into Staples' market share. But I think right now this market's sorting itself out as Office Depot and Office Max merge. And as the economy actually overall recovers, because it really hasn't recovered back to where it should be. We start a small business.
Staples does have a pretty good online presence with Quill, doesn't it?
Yeah, it's the second biggest online retailer in the country after Amazon.
Yeah.
I mean, it's a kind of a hidden gem, really. And it knows how to do that well. So I'm quietly confident about Staples, but I think what could happen to it actually is that an investment entity, an investment bank, a set of investors could come and buy the company, take it private, trim back some of its stores a little bit, because it probably does have to cut back in some of the underperforming stores that it has. There's not as much foot traffic anymore. When you look through those numbers, you can see that really people are not deserting the stores, but they're not doing as well as they have done in the past, and that's an overall trend right across the board among all retailers.
Yeah, and clearly they're a well-managed company that if they can identify a couple hundred stores that are underperforming, they can put the profitability of the company back on track, and that's what the investment bankers are going to be watching for. So,
but I think a lot of it has to do with the overall recovery of the economy.
Do you think, Hugh, that we'll ultimately end up with like a Lowe's Home Depot situation with Office something versus Staples?
Yeah.
Okay.
And I think Staples will win because of its online. It's a behemoth online,
So you think that it will eventually push the Office Depot, Office Max combination out of business then?
I think it's going to, honestly, although Gordon Bethune was the CEO of Continental, and he used to have a good line when it came to airline mergers, and investment bankers would get excited about it because things looked stable. And he agreed, but he would say it's like two drunks holding each other up at a bar.
Okay.
Wow, I can relate to that.
Get ready for Bink.
Yeah, there
Mark,
you go.
Jane has found the citation about the split information, and she was mistaken. It actually comes from the Kiplinger letter on September 2013. The Kiplinger's personal finance advisor. It's on the back page. So if you want to go to a library, folks, and look that up, September 2013, Kiplinger's personal finance advisor.
I'll see if I can't track that down, and then see if we can't get some discussion going. I'm going to go ahead and skip over our 3D thing. I just included it there. We keep track of the 3D technicals as a non-core holding. It's kind of relaxed back into definitely a hold type area, perhaps even approaching a buy. So if the questions are clear.
I will say something about 3D if I could, Mark.
Yeah, go ahead.
It was so tempting when 3D was selling for a lot of money, over $100 a share to cash it out, and it's equally tempting right now at I don't know $42, $43, $44 a share to add to the holdings, but I want to keep reiterating that the position that I took in 3D was meant to be a long-term position where you don't touch it. You just ignore it. You leave it alone. And so I'm perfectly happy trying to keep a blind eye to the whole thing. And I've gotten some questions about, am I adding to the position? The answer is definitely not, just like the answer was definitely not, am I selling the position after I had owned it for about 8 or 9 months. I want to own this long term because I think it's disruptive, and I think its best days are in front of it at the moment, at least. That's my thesis for owning the stock in the first place.
Yeah, and all Ken is really saying is he expects things like this and this to happen. And at the same time, the long-term trend is like that. So, you just learn to kind of bide your time with a company like that. My wife feels the same way about Facebook, by the way. So, all right, any other questions, Ken, or can we go ahead and move to the next segment? Doing pretty good on time. Matt's got a nice, thorough presentation for us. Good to go?
Yep, let's keep going.
Okay. Well, go ahead. Like I said, Matt's one of our leading guest knights, and he would like to present Air Lease Corporation here tonight. So take it away, Mr. Spielman.
Great. Thanks, Mark. So just to introduce this, kind of a convergence of things, this is another pick out of the Manifest Attic, but at the B.I. Baker Model Club, we had a discussion, I don't know if it's last session or time before, but someone brought up an airline, and there's some interesting ones there. And I have been a follower and a fan of air transport, I'll say of many types, as an engineer, and just to marvel at those flying machines for a very long time, but I avoid airlines like the plague. So I came across this as I was just looking. It's really the first stock I've been really interested in this year. That's a condition of the market as it is today, and also of my own schedule at a very busy Q1. But I hope you'll find this will be interesting. I'm going to start with a little bit of a discussion of the airline industry, and then put Air Lease, which is a relatively new company, in context of that. So you can't talk about Air Lease unless you talk about its CEO, Steve Hazy. And Steve is a colorful character. You can see him on the left there. And like many entrepreneurs and billionaires, he has a Gulfstream 4 jet. But unlike most of them, when he boards his jet, he turns to the left, not the right. The left meaning he goes to go fly his own plane when he travels somewhere. So he is an airplane guy through and through. You can see some points there. So at the tender age of 27, he decided he'd want to deal in these high capital, high cost things called airplanes, and founded ILFC, the International Lease Finance Corporation, in 1973 with 2 partners. In 1990, ILFC was sold to AIG for a nice profit, but Steve actually stayed with the company and continued to be CEO. He left ILFC in 2009 after the parent company, AIG, had a government bailout and started to get oversight, help from the government oversight. In an interview article, Steve mentioned in particular, although I'm sure there's a lot more value add than this, but the overseers, for instance, wanted to know what his magazine subscriptions were as they watched the company's governance. So certainly as an entrepreneur, that kind of micromanagement was intrusive to him, and he left. And I'm sure as soon as his non-compete clause let him, in 2010, he founded Air Lease. The picture at the bottom, and it's too small to read, but just for illustration, again, what a maverick he is, that's a Google Maps that shows the route between the ILFC headquarters and the Air Lease headquarters, and Google Maps writes that as a 4-minute walk. So it's literally around the corner, so he can regularly keep an eye on him, I don't know, see what customers are coming in, or maybe thumb his nose. My wife thought maybe he didn't want to give up. He had a really nice parking spot in a garage in between, maybe. So, a maverick guy. Okay. So, some good news about air travel, right? Air travel itself is actually a very consistently growing business. It has a very long-term trend, you see back from 1970. Of a 5% compounded annual growth rate. That is, the RPKs are revenue passenger kilometers. So although the price doesn't remain the same, the opportunity of people wanting to travel places is the same. And then particular to leasing companies on the right-hand side, The commercial fleet is also increasing. Now this is a much shorter trend, and you can see during the recession in 2008 it went down, but quite a healthy growth rate even over these difficult 4 or 5 years. One thing I'll mention too, you'll see the source as a number of things, but most of these graphs I've picked from are 2 publications from IATA, the International Air Transport Association. They have their 2013 annual report. That's the last one that they did, and there's also a much longer term item called Air Transport 2050. So if anyone thinks that 10K forms are a little too exciting, you can go to an industry analyst or analysis and really see way too many statistics. So let's go to the next page. So air transport is growing, but what about the airlines? Certainly we've all heard a number of stories about airlines. They seem repeatedly in bankruptcy, and you wonder if it's true or not. So the first thing is this is a very fragmented industry. So again, IATA's 240 members comprise 84% of all air travel. There is not a dominant airline globally, although you might count the airline alliances as something approaching that, but they still are independently run. And the 2 charts below really tell the tale of profitability. You can see on the left-hand one of those 240 members, there are 14 that bring EBIT margins, so that's earnings before interest and taxes, of 8% or greater. That's not great profitability. That's profitability that it might pay for funding you to work. And you can see at the very top, you almost lose it. The industry is barely legible. The chart on the right takes that industry chart and puts it over a time series, so you can see the overall profitability of the industry, and clearly that is not up straight and parallel. That is a definition of the cyclical industry. So next page.
He was going to steal that chart.
So if your customers are that unprofitable or that poorly profitable, why in the world would you want to get into leasing with them? One thing that makes this time right now an interesting time for leasing is there's a high opportunity for fleet turnover. You can see on the left a number of new airplane types, both from Boeing and Airbus, which have been introduced in the case of the 787, but nearly introduced or coming up on the near horizon. And these are different classes of airlines, wide bodies and narrow bodies, but they all address what's on the chart on the right. They all promise at least a 20% improvement in fuel consumption over, and they say current aircraft, so you say maybe the previous generation aircraft. And the pie chart on the right shows that fuel is the #1 cost overall for the industry for airlines. So that is a very tempting target to go after if you can handle it, and if you can do it and your competitor can't, that's a big break. Okay, next chart. So besides that opportunistic time, there's also a difference in industry dynamics here in the leasing companies versus the overall airline companies. And you can see this is a chart from ILFC, actually, an analyst report from last September. And this shows the total fleets of the players in the industry. So there are definitely 2 dominant players on the left. The first one is GE Capital Aviation Services, obviously a unit of GE Capital, itself a unit of GE, which also is a major manufacturer of aircraft engines. And then ILFC itself, again, until, or at least for sometime this quarter, a subsidiary of AIG. What I think is interesting about this chart is I think ILFC means to say that they're one of the 2 big players and everybody else is small. But one of the important things is to look at the lighter section on top. You can see ILFC says 346 aircraft on order, and they don't bother filling in anybody else's. But if you look at Air Lease on the far right, Air Lease actually has 327 aircraft on order. It's a little bit further out. That's through 2023. ILFC's numbers through 2020. But if you are a aircraft manufacturer and you're looking to give decent rates, give preferred time slots, meaning early deliveries, they're actually, and in particular, by the way, that was the CEO of the other company, that's actually playing pretty closely on par. One other big news item that changes this map as well is AirCap in the middle there. That's a Dutch company, is actually buying ILFC from AIG. AIG was looking to divest ILFC and had a group of Chinese investors lined up, but the deal fell through. And so now in second quarter of 2014, AirCap, in a very interesting transaction, is looking to buy ILFC. Believe it or not, you wouldn't judge it from those piles, but ILFC will own 46% of AirCap in the combined company. So you have a very profitable little company buying a much larger company for what looks to be a bargain price. Next slide. Okay, so this is some data. This is my own chart, but this is data of the future aircraft orders of Air Lease. So Air Lease has two significant strategic differences certainly from ILFC, but from Air Leasing in general. First is that they purchase and lease only very specific models of airplanes. These models are ones that they deem very high in demand and very easy to move from one lessor to another should they get a cancellation or a default. Also, they only intend to use these aircraft for the first third of their useful lives. Aircraft generally have useful lives of 25 years. As we have this high turnover, that may shrink somewhat, but is proven to be a long-term trend. Air Lease looks to only use these, again, for the first third of the life, 8 to 10 years, and then sell them, dispose of them for others to worry about the older aircraft. So they want to keep, they're more like a car lease, or they want to keep new models and popular models going on. But I'm interested in this chart because this is going to be the basis that I use for my revenue projection for my SSG. So I'm interested in two things. First of all is the overall growth of aircraft orders, and that's shown in the years 2014 to 2018. The after column is actually the next 5 years. It's 2019 through 2023. And then I'm also interested in the fleet composition. So unless there's a significant disconnect in supply and demand, for example, a wide-body airplane, much more expensive to buy, much more useful in terms of more passengers and longer distances, will lease for a larger price in narrow body. So I want to look at the current composition of the fleet versus in 2018 and see at least a comparable, if not exactly the same, mix in terms of the type of airplanes, and that holds true. So that will allow me to look at the numbers of the air fleet and use that as a shortcut or projection for the revenue increase. The other thing I want to make sure, since I'm counting on these numbers so much, is I want to make sure not only are these aircraft ordered, but they're also leased. So it's not on this chart, but I do have those numbers. So the 2014 class is 100% leased. Also the 2015 class is 100% leased. 2016 is 60% leased. 2017 is 37.5% leased. And 2018 is 22.6% leased. So certainly the first 2 years are already spoken for. That's a done deal. The management comments on the other years is that they're comfortable with that, and they believe that this follows their prior patterns and will become that as well. So these are birds in the bush that we can count on as revenue under long-term agreements, even though, of course, those can always be broken for a cost at some point. But very solid in terms of revenue generation. Next slide. Okay. So looking at the SSG, and certainly one caution here. This company is very young, so we're taking just a few years of data. You can see it's been public only since 2011. So we miss out on something I think a lot of us may have gotten complacent or not realized we were reliant on, was the fact that we could look at straight lines through the recessionary years. So that's one caution. But certainly I am projecting a very, in this way it almost looks like pessimistic amount of growth. So again, my future sales growth estimate, 11.9%, is based on the fleet increase. And my future earnings per share growth is a little bit higher than the sales estimate because, and you'll see their operating margin has increased significantly in the few years that they've worked. And so I'm projecting just a slight increase in operating margin from there of 35%. So relatively, and certainly in light of the historical performance, very conservative estimates. Okay, let's go to the back. So the PEs is, again, very difficult with early years. I just struck out 2011, its startup year. I'm looking at 11.9% sales growth, 14% earnings growth. So I look at a high PE of 21. That's approximately would be a peg of 1.5 from a 14% growth. We did achieve 21.6, but again, in 2013 they didn't achieve that. So I think it's a reasonable compromise there. And the average low PE of 12.5. Last year actually went a little bit below that, but given where I think earnings growth will be, I think it's reasonable for a low PE. Okay, next one. So then looking at the payback ratio, or the upside downside, fortunately we're down a little bit. So 35.99 would put us in the buy range. It's pretty high there, but it's nice, again, with very conservative estimates. And I'll say when we look at the manifest investments, you'll think I'm absolutely pessimistic, but I end up with a buy zone. So I'm quite comfortable with this one. And you can see the par of 9.7 and a total return at the high appreciation rate of 14.7.
Good stuff.
So finally, and again, this is a new company, so I want to make sure that we talk about opportunities and threats. I mentioned some of the opportunities. One other thing that's quite tactical is Air Lease is making use of this low interest environment to really build up their credit, and you'll see a very high debt to equity ratio. ILFC, for example, has a overall interest rate they're paying of 5.87%. Air Lease is paying 3.6%. As a brand new company, which actually just got their S&P rating last August. And there is also, in addition to the air travel growth, there's actually an increased percentage of the aircraft fleet that's being leased, so growth upon growth is nice to keep its revenue growth going. Lack of focus in recent years of larger competitors, that may be solved when ILFC gets bought by AER, but you still have GE with an understandable synergy from leasing aircraft and selling engines, but still not wanting to use aircraft with engines from other companies. And then ILFC have a little bit of a mess to get themselves out of. Now threats, again, I mentioned the AerCap purchase. Of course, we've seen with not only the Airbus A380, which Air Lease has not purchased or leased, but certainly the Dreamliner is in their radar. You have hiccups in the road with all these new models, and that can delay your timing, that can delay your revenue. One thing I don't have listed on here, but because I've compared them to ILFC so often, you should also be aware that ILFC has sued Air Lease and sued Steve Hazy personally for poaching their employees and stealing their methods. Now, Air Lease's assertion is that there is no corporate secrets in the methods that are used, that it's just financing, it's economic theory, and that he's just exercised his personal network. So there is that hanging over the stock. I would not see that as being anything more than corporate rivalry, but it's something to look into.
Good stuff. Well, thanks, Matt.
Sure.
Yeah, we'll wrap up there, and I think we'll hold questions until after if somebody wants to follow up with a question for Matt, but we will be opening the floor for questions and sticking around for a few minutes afterwards also.
Matt, you do have a question from Jane. She'd like to know, is Air Castle a competitor? And if it is, how does it fit into the picture?
Yes, Air Castle is a competitor. I'm trying to think if they were in the. You want to go back, Mark, to the ILFC chart? I don't remember if they were in there or not. I don't see them in there, but yes, they are in aircraft leasing as well.
Yeah, I can't believe they're smaller than all of those, but perhaps they are. Or maybe ILFC chose to leave them off the chart for some reason.
Yeah. There are plenty of hidden messages that the slide is meant to convey.
Interesting. Anything else, Ken?
That's good for now, Mark. We'll come back to a few.
Okay. All right, let's go ahead and kick around something else a little bit unconventional, but Ken and I actually ended up in the same place from two different directions today. The company is Universal Display, ticker OLED. Ken is going to go into a lot of detail about specifically what they are, but I mean, they were splashing all over the trade show in Las Vegas earlier this spring, and they work with a whole lot of people that make screens and displays and that kind of stuff. They've been around for a while. They have a track record, but what we want to dig into is kind of a special subject about maybe a little bit different way to think about screening and going after some companies that I played around with here over the last day or so. And here's my inspiration. This is the Broad Assets Investment Club from St. Louis. I don't know if anybody's here from St. Louis, but this group of investors has actually won our group competition the last 2 years at Manifest Investing. Two trophies, 7 years we've been doing this. They've taken the last two, and in fact, they were near the top of the standings here recently. And one of the reasons I want to dig into this a little bit is they had a stock in their group, and in fact, for the last 2 years when they won, and it's still in this year's Groundhog portfolio, and the company is actually Lannett Company, ticker symbol LCI, and it's gone gangbusters for them. And again, I just kind of want to talk about, because look what it's done for them. 2012, 2013, and they still have it in the 2014 contest. You can see that it's kind of misleading, but from February to the end of early into 2013, they actually had a tripling of value from about $4 to $12, and then from $12 on up to nearly 36. So again, it basically tripled 2 years in a row. And it's doing okay again this year. And just want to kind of dig into some of the rationale behind it. This happens to be a generic drug provider and a relatively small company. You can see 300 million-ish in sales, and it's also relatively small by virtue of the mid-teens growth rate. Okay, had a financial strength of B, which again is a little bit lower than we typically are used to, but actually a fairly formidable company. It'll be interesting to see if Hugh has anything to say about them. But what I want to focus in on is this characteristic of, basically coming out of a period where they didn't have positive earnings as they were basically emerging into profitability. You can see kind of a false start here. But then come 2011, 2012, they make this step increase and take a step into profitability with, all indications that they're continuing forward in a profitable manner. And so my question was, could we perhaps find some companies that fit that description, that basically have that same characteristic, just to reinforce what we're looking for here? I think what Broad Assets has actually done is captured a company at a very optimum point in its company, not product, but company life cycle. So you can just think about company life cycle. And we're talking about that period where they do become profitable and stay profitable. And this entire zone here is our sweet spot for long-term investing, and known as up, straight, and parallel. This is literally the up, straight, and parallel zone. And all Broad Assets has done is tried to find a way to identify a company early on in that process, or early on in that cycle, to basically maximize profits and get in early and, again, maximize profits. So how might we take a look at that? Here's earnings going back for 2013, 2012, and 2011, historical numbers over here, and then a couple years of estimates for year-end 2014 and 2015 for a number of companies. I wanted to pull Lannett, however you say it, to just kind of demonstrate this is what they would have been looking at a couple of years ago. A company, breaking into earnings, breaking zero, and then basically tripling, and then tripling again, and then continuing on through 2013. So there's the pattern. I mean, there's no negative earnings here. Very strong. That's what we saw on that chart on the SSG. So my point would be, I think we want to try to find some companies that perhaps fit that description. Okay, and you can see that pretty interesting list of companies, not the type of companies that we typically become involved with. These, again, are early stage, so they're going to probably have lower financial strength, a little bit lower financial strength, and probably a lot less earnings per share stability or predictability. And you see that in some of the numbers. So from top to bottom, again, I went through and kind of threw out anybody that had too many of these, because Lannett didn't have those. So if they had negative earnings, I might skip over them. I find it hard to be too interested in this Chinese internet company yet. I'm still not ready to go there. Netflix, you'll see in a minute, maybe a little bit overvalued, but some companies kind of interesting on there. Let's take a look at that same information, only now we're looking at year-over-year comparisons. So we're basically taking the 2012 results and dividing by the year-end 2011 to see how much. So this shows you those, for last year's contest, this is what they would have been looking at for Lannett. Incredible gains. By the way, we capped that at 200. So we basically capped that as we are looking at, it's basically a tripling of earnings year over year. And what I wanted to do is take a look at a list of companies and sort them by the 3-year average of that characteristic. Okay, so we're basically looking at the entire universe of companies that we follow, about 2,300, 2,400 companies, looking for the companies that have the strongest 3-year average earnings momentum. And so what we're basically looking at is the average of these 3 years, and then taking that result and sorting it from highest to lowest. Okay, so again, this is the companies that showed up on the list from highest to lowest, and just kind of trying to back into a company that might somewhat resemble, in a fairly strong way, what Lannett looked like a couple years ago. Okay, so there they are in terms of the ranking by how they perform year in and year out. And let's go ahead and see what they look like in present day form. So here they are here. Again, we want to focus in on companies that are relatively small or relatively fast growing to be consistent with what we saw from Lannett. So again, any companies that had too low of a growth rate basically would have tossed them out. I left host hotels in there just for kicks, but I would throw that one out. It's just a little bit too low for our purposes here. Besides, the return forecast is a little bit too low also. Again, I mentioned I don't think I want to get involved with the Chinese internet company, at least not yet. And so that one falls off the board. Netflix, again, great company. It's had a heck of a run, but right now the return is actually a little bit low, so I would not go for that one. And by the way, those of you that have ever been burned by shorting a company like Netflix, I think this is a very interesting list. Many of these companies have gone up a tremendous amount, because again, keep in mind that we believe that price will follow earnings, not earnings growth, earnings. And when you chart out the earnings on our visual analysis, we think that the price will follow that. Well, if you're dealing with these type of numbers, these companies are virtually impossible to short. And some of you may remember we did a feature on Whitney Tilson shorting Netflix last year. He got absolutely hammered. And some of the other big guns on Wall Street have done some of the same things. And I look down this list and I see the Facebooks and Groupon is just off the list. Again, these are not companies to bet against. Even if you don't understand them and just step back and watch them, betting against them would probably be a really bad idea. I think this one's a really neat study. I don't know enough about it, but gas log, looking at these numbers over here, some pretty good stuff. So again, we're dealing with relatively small companies, fairly decent high profitability as measured by their net margins or their returns on equity. Again, not too many nosebleed PEs. These are a little bit high, but not too bad. And again, Lannett had a fairly low, a B financial strength rating from Value Line, so it can be an acceptable situation for a non-core investment. I'd like to see 40, maybe 50% if we can get it, but not the most important thing. And then the earnings per share stability, we're talking about companies that are coming from below zero. So these are going to be, by design, naturally lower. You just have to, again, it's one of the most prevalent characteristics of a non-core company would be a low earnings per share stability. But again, this is more of a special situation or a potential speculation. So coming down the list, I come to this universal display. 30-ish% growth rate, very high profitability here, not an exorbitant PE, decent financial strength for a company at this stage in its life cycle. Again, the EPS stability, not high, but again, fairly natural for a company of this kind. And we find a pretty decent return forecast and a decent quality rating thanks to the high growth rate and a few other things. So as I work down this list, there's a couple other companies that kind of talk to me. This Wisdom Tree, kind of an interesting study, like some of the stuff they're doing in the mutual fund market. There's some natural gas companies down here that kind of tug on me a little bit, and maybe understand what might be going on in the natural gas industry and look for opportunity coming out of what's been happening there. But the one that really does jump off the page happens to be this Universal Display. Here's what it looks like taking a look at it again with the stock selection guide embedding a couple years of estimates. This basically, we are here right now, about a third of the way through 2014. Decent track record when it comes to the top line. They make excellent products. Coming through a period when the price has basically sagged down at precisely the time when they do seem to be coming out into continuing profitability. So again, they're very vulnerable to a speed bump. Need to be taken as a warning. I wouldn't put a huge part of any portfolio in it, but even with Ken and my selections here tonight, this will represent a tiny piece of our portfolio. And again, the high quality nature of what we see coming out of this company and the management characteristics and the opportunity field in front of this company make it quite compelling. And again, Ken will have a few words on where he thinks the profitability is going, but pretty decent looking picture. And again, finding it in a slightly different way. We'll basically put those charts out and let everybody pour over them, but might be a way to find an opportunity similar to what Broad Assets has experienced here the last couple of years, and see if we can't learn something about the process and some of these companies, especially for identifying non-core investments. What comes to mind for me is the work of David Gardner over at the Motley Fool, where he has selected companies like Netflix, very early stage, and a couple of others. And I think this type of technique would basically be mining in some of the same areas of opportunity given time. So my selection will be Universal Display Corporation, ticker symbol OLED. And we'll turn it over to Ken for more detail on what they do and his forecast and assumptions on the company. Ken, did you want to take the control of the slides?
If you could send the screen to me, Mark, that would help.
Let's go ahead and do that.
And let's see if I can.
Should be landing.
There we go. And are you seeing my screen now?
Got it.
Okay. Well, I came up to this company in a very different way than Mark did, a very old school way. I've related before that Natalie and I many times look for disruptive technologies. We look for things that we think might be really big 5 or 10 years from now, and then try to find companies that do the idea that we're talking about. And we've been talking about LED lights for 18 months or 2 years, and have never really found a company that we really liked about LEDs. We've looked at Cree and a couple of other larger manufacturers and just have not been really impressed with what's going on. And so we've put it on the back burner a couple different times. Recently, I started going through small and mid-cap value line page by page. I still get the paper edition, and I still love to play with the paper occasionally. And I was writing down the names of stocks that were not being followed by Manifest Investing, and I came across this OLED, and the ticker led me to believe that maybe this had something to do with LEDs. So I did some study on it, and here's where the study led me. First of all, what is an OLED? Well, it's an organic light-emitting diode. That's a lot of gobbledygook for those of you that are non-tech out in the audience, but just think of something organic. That means something that is not a chemical out of the ground like copper or something like that, but something that's an organic compound, and it's layered among other organic compounds, and the whole thing, if you layer it with the top layer being a cathode or an anode and the bottom layer being the opposite, that just means a positive charge and a negative charge, you can make the darn thing glow. Originally, you could only make it glow in blue. The original LEDs were all blue, and then we kind of got some green ones and got some red ones, and then people figured out how to make them come together to make white types of light. And now we're working on light that is the same quality as incandescent light. Well, the nice thing about these OLEDs are that they can be made very thinly, they can be made very cheaply, they can be flexible, and they can be transparent. There's a large market for this kind of LED. If you look at this graph right here, you'll notice the mobile market. That's our telephone screens, our MP3 player screens, our iPad screens, things like that. There's a television market out there. There's a tablet and PC market out there. That's the green portion of the bar. And then we're gradually coming up with other applications for these LEDs, and I'm going to show you a few of these in this presentation. This presentation, by the way, is a choice of slides from a longer presentation that you can find on the Universal Display website. It's a great presentation. If you're interested in this company, I'd urge you to start your research there. These OLEDs by Universal Display are on the phone that I use. I happen to have a Galaxy S3, and so I'm familiar with the OLED. I didn't realize what I was using, but it's a very, very thin phone, and it has this screen that's very thin on top of that. I also have a Samsung Galaxy tablet, and my Galaxy tablet is also using the OLEDs. You see here some other pretty traditional uses for these LED products, but this is where it starts to get very interesting. The LED products, this OLED is flexible. And if it's flexible, you can be sure that somebody is going to use that idea to create a new piece of technology that will allow you to do things that your old piece of technology won't. So think of bending your phone. Think of putting it in your back pocket and allowing you to sit on it, for example, right now. Think of displays that are huge. These OLEDs can be turned into 55-inch screens, and that's at the really big end of an LED display. It used to be we had to go to an LCD display, a liquid crystal display, to get these really huge TVs or a projection type setup, and now we can get these lighter, very thin LEDs in these huge televisions. Well, you put huge TV with flexibility and you get rounded TVs, TVs where you can sit in the sweet spot and have it surround you by 180 degrees, maybe even more if that makes sense. Universal Display works with many, many different corporations. They have a large part of their budget devoted to R&D, research and development, strategic partnerships with some of the premier universities in the country. One of my alma maters right there, University of Michigan. Collective relationships, collaborative relationships with many other companies, some of them familiar to us, some of them not so familiar with, and then they also work very closely with their customers to devise different solutions for perceived problems. Here's some of their partners, and some of the largest companies in the world use Universal Display equipment. What I found interesting is that they have a very deep penetration in patents. Universal Display does. They have patents in a whole slew of different areas, and right now they have about 3,300 patents. As those patents go offline, as they expire, Universal Display is projecting that by 2030 or so, they'll have somewhere in the neighborhood of 5,000 different patents in effect that they will be using to help move this technology to as many areas as possible. Look how thin they can be made. Look how they can stretch and how you can use them. Think of a light that's as thin as this piece over here on the left, and it's providing enough light to read by. Where's future growth coming? Well, future growth is going to be coming from all of this thin film and plastic substrata systems design. All different kinds of things are going to be able to be created and manufactured using these LEDs. And the interesting thing is that most of them are not going to have to take a normal wire to attach them to get power. Most of the power will come from different types of battery sources because these LEDs take a really significant small amount of power. Also, think about printing light. Think about that for just a moment. Printing things using an inkjet or a standard nozzle computer, or using a vapor jet printing system that prints light right onto thin surfaces. Think about having the ability to do that. That opens up all kinds of creative and unusual products that can be manufactured. Here's an example of some lighting, and again, these things weigh virtually nothing, and they're in all kinds of shapes, and they can be bent around and dealt with in all kinds of things. These LEDs are instant on, and they dim without flickering, so you can dim them. They don't create background noise like a lot of lighting does when we're dealing with sound equipment. They're thin, they can be made completely transparent, they're non-breakable. So there's all kinds of advantage. Here's some more of the products. Look at those doors down there made by Kaneka or Kaneka. The panes in those doors are transparent during the normal daylight hours, and they turn into lights that you can turn on and off during nighttime hours. Again, right onto a piece of glass or just the light standing by itself. The different shapes, the creativity that can be brought into this whole picture. Obviously, we're in a complete evolution, and we're transforming lighting from the Edison light bulb in the 1870s to these OLEDs, these organic light emitting diodes, and we've gone through a number of different things. Did you ever think that that swirly compact fluorescent would be old-fashioned? And even a lot of the white LEDs that are being sold today in the Costco stores and the Sam's stores, they're old technology, and they're not going to be around for that much longer as we move to these different types of lighting. The long-term roadmap is to move from the traditional usages for these things in mobile devices into tablets and TV, then to move into things that can flex and become very thin, and then finally to move into creating lighting in all kinds of places where we never in 100 years thought we'd be able to bring lighting without a lot of wiring and a lot of substrata and different things that we're going to have to support those lights. I do want to mention before I move to my SSG that this company has adjusted its earnings. If I bear into the annual report, I will find a lot of money allocated to the income tax and the release of the income tax valuation allowance, and then the total non-GAAP reconciliations. When I reevaluate and use the company's more basic income and forget about the fact that they've had some pluses as far as income tax is concerned, I get revenues to move from $1.50 something to about 70 cents. So as I do my studies, I'm going to use that 70-cent revenue And I'm going to move really quickly to my toolkit here and show you that I've adjusted that last earnings number to the 71 cents that the report shows as an adjusted value. If you just take the data as it comes from Better Investing, you're going to have $1.50 something in there. And if you notice under notes, I've written a note to myself that the original $1.59 reflected some tax profit, and that the 71 cents is more accurately displaying what the company would be earning if they didn't make that profit from their taxation.
Ken, interestingly enough, on the Finance Yahoo consensus estimates and results, that 70 cents is what's there. That's why that's what it is in Manifest.
Well, it's not what it is in Morningstar. So,
okay. All right.
And that's why I made the point that it's all spelled out in the annual report. Here's the analyst estimates for the next 2 years, and Mark is certainly correct. There's quite a steep line moving through those. Once they became profitable, they really took off on their profitability, and I've set some pretty conservative growth lines, if you'll notice, but they're quite a bit under the analyst projections. But if you'll notice, they're at 25, and many times when I'm dealing with companies, I won't go over 20 for any reason. But for this relatively small company in this explosive stage of growth, I think that they might be able to reach this 25% growth over the next 5 years. So that's what I'm using in my analysis. I see this huge increase in profit margins moving very quickly, and I would estimate that profit margins would stay at least at the 25-26 percentage level. I would hope to see a continued increase in return on equity as the company becomes more profitable. And what I like is that very quickly here the company has moved into ranges that I won't call reasonable for PE values, but they're certainly more reasonable than 900 and 300. I'm getting a 56 at the high and a 35 at the low. And if you'll notice, I've been extremely conservative moving down in my PE values. I've chosen an average PE of about 22.5, 30 at the high, 15 at the low. I've adjusted for the most recent trailing 12 months. Although that should be a 0.71, I'm going to leave the $1.59 there because I'm going to choose around $24, $25 for my base. That gives me a good solid buy. If I were to put the 71 cents in here, all I would end up with is a larger upside downside. So I'm going to keep the $24 there. And I'm getting about a 12% to 18% return. Now, if I compare that on a Manifest study, and here I am, and it just went blank on me.
Well, your screen's doing that thing again.
Yes, it is. Let's see if I can refresh it. There we go. And under my studies, I did my own study on OLED. And I'd like to show you the eagle that I did on Manifest Investing. Here it is, and I had the ability to change a number of these rates. And I did change the annual rate for sales. I changed the net margin down to, well, I was extremely conservative at 22%. You can play with this eagle in all kinds of ways, just like the SSG. And I brought the par down to around 16%. Now, that's quite different from Mark's par of 36.4, but, you know, I'd take a 16% return for the next 4 or 5 years, annualized. If you'll give it to me, I'll take it. So all in all, I think that this company, again, I'm not going to bet the farm on this company. It's certainly a non-core holding. But I'm ready to put a few dollars into OLED and see what might happen in the next 3, 4, 5 years. I will watch it fairly closely. I'll keep it on a fairly short leash, and I'll watch especially problems that they might be having in manufacturing and in getting and keeping customers. but at the present time, those problems seem to be well in check. So I won't worry too much about the company, and let's see what kind of profit I might make on it. So I'm going to also add OLED to the portfolio, Mark.
Fantastic. All right. Well, do you want to go ahead and switch the screen back to me then? We'll close things out.
I'm in the process of doing that right now. Here you come. And I also have a poll ready if you're ready for that, Mark.
Let's go ahead and do that. I didn't do anything other than to put the picture of the bear up for McManus. He'd probably like to see Irish Wolfhounds instead, but any comment at this time, Hugh?
No, not from me.
Okay.
Okay, well then let's launch the poll tonight and give you the choice of adding Air Lease, Universal Display, or none of the above to the portfolio. All you have to do is use your mouse and click on the stock that you would like to add. We're going to wait till we get about 80% of our audience voting. We have a nice turnout again this evening. Very pleased with the turnout. We're up to 82% voting, so we'll give you about 10 more seconds. That takes us to 87% voting right now. So let's close the poll and share the results. Whoops, did I share those long enough? I probably didn't, did I?
I didn't see them, so I don't know.
And we have 17% of you that would like to add Air Lease. We always have a very speculative audience, Matt. Don't feel bad. Whenever we talk about a speculative stock, they go for it big time. So
guess that one good year and you gang up on us 2-1. That's the thing.
Yeah, that's it.
I definitely can't top both of you together.
And we had 4 or 5 people saying they didn't like either one of them. So let's add an audience choice on Universal Display as well then, Mark.
Fantastic.
I'm looking at the competitors, and Herb would like to know who are the competitors for OLED. And Herb, this is a really fragmented market with a lot of very small companies playing around with LEDs. One of the larger competitors is Cree, C-R-E-E, and they make a lot of the bulbs that mimic the look of the incandescent bulbs, but there's a lot of different very, very small companies out there working on LEDs. And again, folks, before you actually buy something, I'd urge you to study a few of the competitors. You can always find the names of those by looking in the company's annual report, sometimes in the S&P report. They're available if you do a little bit of searching. A good Google search a lot of times will turn up companies as well. Mark Ann would like to know what the star next to a stock's name means.
It just simply means it's not in the Value Line Standard Edition.
Okay, and Matt Shirley would like to know exactly how does a leasing contract work for AL? Is it just basically an airline signing a lease with AL and they get the plane?
Yeah, in air leasing you have different things. You may have what's called a wet lease, which means that it's really like chartering a plane. So you get a crew, they pay for gas, it's all inclusive. But air lease is much more basic than that. It's really just the airplane, and the airline is responsible for everything. Their own crew, gasoline, they're responsible for a certain amount of maintenance is recommended by the manufacturer, and then even paperwork like insurance and whatever duties and regulations in the countries they operate. That's all the responsibility of the airline.
Thanks, Matt. D. Smith would like to know if somebody is willing to comment on the recent PRAA acquisition of Active. They spent about $1.2 billion for it. Mr. Smith or Ms. Smith, I will do a little bit of work on that and try to get back with you at our next roundtable. I don't currently own PRAA myself, so I haven't been following it as closely as I would if I in fact owned some of the stock. But that is kind of intriguing, a $1.2 billion acquisition. I'm going to guess right now off the top of my head that they basically bought a portfolio of debt from a company that had a large portfolio of debt, and that this company, PRA, is known to pay very good prices for the debt that it purchases. But I will do some research and get back with you at the next roundtable on that question. And then, Mark, we'll end. The last question on the queue is from Susan, who would like to know, is Manifest investing based on a subscription, and is it an annual fee?
Yes, it is an annual fee, and an annual subscription of $79 a year for individuals. We do some group discounts if you're part of a club. You can, or an investing group, you can write to me at markr@manifestinvesting.com if you'd like more information on that, Susan.
Okay, I got another question here. Adam would like to know, Hugh, you're up. Adam would like to know if you have any thoughts on ISIS.
Sorry, I thought I was muted. I'm not. I'm being asked that question presumably because I bought it in a portfolio or a competition in the past. I actually do like the company. It goes up and down 5% a day, so I've never delved into options there, but I'm tempted every time I get an alert that it's down 5%, the next day it's back up 5%. ISIS, so in the pharmaceutical world there's small molecules which came out actually of the dye industry, and things like aspirin and Lipitor and all the drugs that are familiar to us are small molecules. Then along came proteins and recombinant DNA work, monoclonal antibodies, things like that. And the next step after that is RNA-based drugs, which is what ISIS does, the pharmaceutical company. And it has a very strong patent portfolio in that area, and it has actually, I think, one drug approved. And in principle, the technology that it develops should work really, really well, because it's going down to the molecular level and correcting some of the problems that can occur when, say, that a genome on the genome is gone wonky, or there's some biological process that's not performing correctly. It should be able to make the equivalent of a piece of Velcro and shut down all activity. So I've always liked the company, but like all companies, it's had its ups and downs. I bought it some time ago when it was way down, low single digits, and I think recently it's close to 30 or thereabouts. But as I said, it's been bouncing around $1.50, $2 here and there over time. And the technology has still really yet to be proven. I mean, it's gone through the clinic successfully in parts, but I suspect that the company will be bought out. Once it's demonstrated that the technology works well. And after that, it's on to gene therapy.
Adam says, thank you, Hugh. And Shirley would like to know, do you know the ticker on ISIS, either one of you?
It's ISIS.
ISIS, says Adam and Hugh both together there, okay? One last question from Don. Mark, when is Manifest going to come out with an update?
We're actually working on an update right now that will be out in the next, I would say, 6 to 8 weeks. It's just a refresher of the site, the platform that the site resides on, with a couple of the wrinkles that we've been working on for a while now.
Okay, that leaves us, here's another question here from Sean. Does anybody have any ideas or any thoughts about soda getting bought out? I don't know, is that SodaStream? Is that the company we're talking about?
Mm-hmm.
Yeah, I always thought that it would have a hard time existing on its own. It's a one-trick pony, but who's buying it out? Does anybody know?
I think they're getting bought.
About it.
Yeah, they're getting bought by Starbucks, right? Or partially by Starbucks.
Well, that's still a rumor.
Yeah.
But yeah, certainly you see Coke taking the position in Keurig, and you think there's some natural things. And I wish I'd asked the Pepsi investor relations person in Chicago last year what she thought. But if you could predict that, maybe you can make a lot of money. But it's certainly a speculation at this time.
Mm-hmm.
So this is all just speculation about the buyout at the present time then, right, guys?
Yeah.
Mm-hmm.
Okay. Sean, I hope that helps a little bit, but we're as much in the dark about it as you are, evidently.
I do think there may be a post on the Manifest forum in the stocks folder on SodaStream that you might want to take a look at.
Okay. Well, Mark, we've cleared all the hands. We've cleared all the questions. And I want to give a really special big thanks to Matt for filling in at the last minute. Hugh, as always, we're just so appreciative that you can take the time to join us once a month. And Mark, I just can't say thank you enough for all that you help us with on this roundtable. With that, I think we're ready to sign off. Anybody else have any last comments?
No, thanks, guys. Great presentation,
Thanks,
Matt.
Good night, everybody.
It's very
Night.
a lot of fun.